If you've received a loan estimate and it feels like a wall of numbers, you're not alone. Hi, I'm Mike at KOOR Mortgage, and I just want to go through a loan estimate with you line by line so you know what everything is that you're looking at. I do this all for all of my clients that I work with, but I know that not every loan officer does. So I just want to get this information out there so that you have it available to you. These numbers are very specific to a client that I've worked with in the past. Looks like this one was from April of 2026. But the main point to know is obviously the numbers are going to be specific to your situation. But the layout, the loan estimate is really, it's a federally mandated document. So the layout of it is going to be exactly the same regardless of the lending company that you work with. Now, I'm a mortgage broker. That means I work with a good number of lending companies. This one just so happens to be through United Wholesale Mortgage, but that's kind of arbitrary for this video. It's just because that could be any lending company, and but the layout's going to be, all of these closing cost layouts are going to be basically the same. So what you're going to see on here is the sale price right here. That's your purchaser price. This one is $315,000. These clients are putting 5% down, which leaves them with a loan amount of $299,250. This is a 30-year fixed rate conventional loan. So your loan term and loan type are going to be shown right up here, and whether or not that interest rate is locked in. One thing to point out on this, if you're working with multiple lending companies and just checking rates here and there and closing costs and all that kind of stuff, it's always good to make sure you're comparing locked loan estimates. You want to make sure that that yes box is checked, because things can change. I mean, the interest rate moves like almost like a stock, so it's up and down at any given time throughout any day. And so if you're going to compare one lender to the other lender, you just want to make sure you're working with real numbers there. So loan amount of $299,000. This client received an interest rate of 6.624. Keep in mind, there's a lot of factors involved in what interest rate you qualify for. So you could Google whatever the interest rate is, but just know there are other contributing factors. So your down payment amount can play a role. Your debt to income ratio. There's just a wide range of things that can go into it, and so I think at this time the interest rates were in the low sixes. So for this client in particular, there was something with their credit that put the rate up just a little bit, but that just the main thing to know watching this video, that's where your interest rate is going to be located. So that loan amount combined with that interest rate gives us a monthly principal and interest payment of $1,915.93. You'll see here there is no prepayment penalty on this. That means that you can apply any additional towards the principal balance at any given time. You can also pay it off at any time. And a general rule of thumb, and it's not like this on every single loan, but so it's just general rule of thumb. If you apply about an extra payment per year towards the principal balance, so you could take that 1915 and spread it out over 12 payments, or you could pay it in one lump sum, whatever it is. You'll take around 7 years. This is averaged around 7 years off your mortgage. That means you automatically go from a 30-year mortgage to a 23-year mortgage, which is awesome. So I got to, again, put that with an asterisk next to it, just because the interest rate plays a role. And so that, give or take, it could be a little bit different than 7 years for your specific situation, but that's just generally speaking. The balloon payment, that means that and when it says no, that means that at no time is the all of a sudden the whole principal balance going to be due. This is a fixed rate conventional loan. That means for all 30 years, the payment stays the same, at least on the principal and interest. Here we've got, again, that principal and interest payment, the mortgage insurance. So anytime you put less than 20% down, you pay a mortgage insurance. Some lenders use or provide mortgage insurance in-house, which can keep costs a little bit lower. Some use a third party, which is typically a little bit more expensive. There's also a lot of factors that go into what the mortgage insurance is, loan amount, and down payment, that kind of stuff. So the more you put down, typically the lower your interest, your mortgage insurance is. Then the estimated escrow, that's your homeowner's insurance and property taxes combined. And that's how we get to the total monthly payment. This is assuming, or this borrower in particular had an escrow account. If you're a first-time home buyer, you're required to. If you've owned a home for 5 years, you're not required to on a conventional loan. But yeah, it's so at that point, it's kind of personal preference. Here you'll see years 1 through 12, and then over here 13 through 30. That's just because of this line right here. You can see that the mortgage insurance goes away. So after you've paid off 20% of the value of your property, you can request to have your mortgage insurance removed. Most lending companies will automatically remove it at 22%. So keep that in mind. If you bought a house and you're paying mortgage insurance, you might be able to get rid of it sooner than what the lending company is going to remove it for you. So again, once you paid off 20% of the value of the house, so in this person's particular situation, they've paid off 5%, so an additional 15%, and they could get rid of the mortgage insurance. Also keep in mind appreciation, so the increase of the value of your home over time could happen even faster than paying off 20% of the value when you actually bought the house. So we've got, so this is just projecting if this client in particular just makes their regular monthly payment, never refinances, never sells the house or anything like that, after 12 years, the mortgage insurance will go away. And then for the remaining term, they won't pay a mortgage insurance. Here, this section right here shows property taxes and homeowners insurance. And over here, it's just indicating, yes, they are in fact being collected in an escrow account. If there was a homeowners association fee or anything like that, it would show there as well. This line here is estimated cash to close. Then this next one is estimated closing cost. This one's estimated cash to close. That's your closing costs combined with any credits and your down payment. So that's what I'm going to go through here on the second page. So points. So some lending companies will get you as close to 0 as possible on the points. But typically the points will, so interest rates work on the 8th. So 6.6%, 6.125, 6.25, 6.375, so on and so forth. And so we typically, when you say even par or not paying any points or not buying down the interest rate, that typically means as close to a $0 amount as possible. But in a situation like this, you might see a 6.624, paying 0.181% in points here. I'm assuming that on this one in particular, 6.75 would have actually given them a credit right there. So yeah, if I've got a video on paying points, if you want to check that out, you can search my page and you'll find it there where I go through that in detail. Next line item here is the underwriting fee. So all lending companies, no matter who, no matter what, they charge an underwriting fee. A lot of times it's wrapped into the interest rate. This section right here is really the only section you do wrap into the interest rate, or could. But what that means is if you do that, you take a little bit of a higher interest rate, and then you end up paying way more than that underwriting fee over time, typically. So I always recommend to people, if you do have the funds available to you for closing, to pay that underwriting fee there, and then over time, once you've already paid that off, so you don't continue to pay for it. If you wrap it into the rate, take a higher rate, your payment goes up a little bit to cover that underwriting fee. And then once that underwriting fee is paid off, your interest rate's not going to change, your monthly payment's not going to change. So you're going to just continue to pay that for the life of the loan. Then next section right here, B, services you cannot shop for. That just means that these are services that are going to be ordered for you, and they're required on the loan. And so we've got an appraisal fee here. This one was $500. Depending on your area, depending on the type of loan, 500 is kind of an average, but if you're in a rural area, it might be 550, 650, somewhere around there. VA loans are typically a little bit higher. Bigger homes can cost more. So there's a lot of factors that play a role in what the appraisal fee ends up being. This is the one and only fee, at least for me on my side of things, that you pay for outside of the closing. So that means it's shown here as a closing cost, but what happens is you get your offer accepted on the house, and then I get the loan estimate and disclosures out to you. Once everything is signed, I submit your file to the underwriter and typically order the appraisal at that point, unless we're waiting on something. When the appraisal gets ordered, it gets ordered through what's called an appraisal management company. We call them an AMC. And that company is in charge of contracting out to an appraiser to go do the appraisal. That way, we've got a step in between us and the appraiser, because we're not allowed to have any type of influence over who the appraiser is or what the value of the property is. That's changed over time. So that's how things are these days. So, and then once that appraisal gets ordered, you get the official dollar amount of what the appraisal fee is. Credit report fees have gone up in recent years. 5 years ago, we were paying less than $50. Now it's up over a little over 100 typically. Most lending companies have these three fees. They're just basically what we call junk fees in the industry. They have this MERS registration fee, flood certificate, tax services, blah, blah, blah. So they typically just throw those in there, pass those fees along to you. This one right here is a processing fee. Not all companies have a processing fee. Some do, that's more, some that's less. That kind of is dependent on the lending company that you're working with to get your mortgage. Some have in-house processors, some use third parties. The processor is a person who's going to work with the loan officer. They're going to work with the underwriter, title company, any of the vendors associated with getting your mortgage. And so that fee gets passed along to you. This one right here isn't always necessary, verification of employment fees. So even though you typically provide pay stubs and W-2s or tax returns or whatever it is, the lending company is also required to verify with your employer that you are in fact employed there and what your income is, what your start date is, all that kind of stuff. Some companies, especially bigger companies, tend to use a third party, and those third parties always charge a fee. So sometimes it's $50, $60. I've seen it cost $95. So sometimes we'll throw that fee if we know we're going to need one. We'll throw that fee on there. And then it can go away if you don't end up needing it or it costs more. Keep in mind, brings up a good point, that the loan estimate is a starting point. These are not your final numbers. And by signing these, you're not agreeing to write a check for this dollar amount. So what the loan estimate is the loan officer's best go at providing you with accurate numbers that you're going to see at the closing table. Now, they can change throughout the underwriting process. Like I just said, that verification of employment fee could be less or it could go away. That credit report might cost a little bit less, or the appraisal might cost a little bit less. And so throughout the underwriting process and before the closing, the fees will change a little bit here and there, and you might get an updated loan estimate if certain fees change. And then at the closing disclosure, or the preliminary closing disclosure, and then the final closing disclosure, you could see some numbers change there as well. So essentially, by signing the loan estimate, what you're saying is, I've seen these numbers, this is okay with me, I'm willing to move forward at this time. And then just keep in mind that some of the numbers will end up changing. Next section, services you can shop for. This is usually most of the title company fees. So there might be some other things, some services, like a sewage inspection or a pest inspection, things like that would go here too, where you do have this ability or the say in who are providing these services for you. So you actually can choose the title company. Most people don't, though, to be honest with you. A lot of people, because you don't buy a house every day, you don't have relationships with these title companies, And so you kind of want to defer. Like I said, it's totally up to you, but you typically defer to one that the real estate agent has a good relationship with, or the mortgage broker has a good relationship with. And that's just because the having a good relationship in this business goes a long way. If you need a little extra work from somebody, or you need somebody to stay at work a little bit longer for you, or answer a phone call on the weekend or something like that, it goes a long way. So working with a title company that the real estate agent is familiar with is pretty important. The other thing, a lot of times people, not a lot of times, but sometimes people like to work with the same title company as the seller, if that's okay with the real estate agent. That way both sides are being taken care of together. Or you just go with your own, because they're gonna represent you and have your back in any type of scenario. So title company fees, they all have some junk fees of their own. The main ones are the lender's title insurance or lender's coverage. That's based on a percentage of the loan amount, along with the settlement or closing fee. $5.95 right now is about standard in the industry. You might find it for a little more, it might be a little bit less. And keep in mind, this is a purchase for a home in Michigan. A lot of states have these sections can look very different depending on what's required by the state. I know a lot of times in Florida, a survey is required. There's just a lot of different fees that can come up, but these are kind of standard fees that we see here in Michigan a lot. Up here on the top right, so what this is, after we close, the title company records your deed and your mortgage with the government, and the government charges a fee. In Michigan, typically it's $65. I've seen it cost more than that. I've seen it cost $135. So I always throw that on the loan estimate, and then we decrease it to whatever it ends up being. It's just a fee from the government that gets passed along to you. Next section, section F here, is the prepaids. That is your homeowners insurance and typically your prepaid interest. So homeowners insurance works a little bit like car insurance, at least here in Michigan. You can shop around with whatever company you prefer to work with. A lot of people get homeowners insurance through the company that they have their car insurance with and bundle them. And then your premium for the year largely depends on the deductible you choose, what you have covered. Like I said, if you bundle, what the company is, all that kind of stuff. The main point on the loan estimate is to know that this dollar amount here is basically a placeholder. It's going to get replaced with whatever you get homeowners insurance for. But just know that they're going to collect all 12 months at the closing. And then after we close, the title company is going to send a check to your homeowners insurance agency and make sure that that first year premium gets paid for. So, and the next line is the prepaid interest. So that's based on a percentage of the loan amount. So it's based on that interest rate. And you pay an interest from the day we close through the end of the month. So typically I'll put somewhere like 15 or 17 days or whatever on the loan estimate, unless we have a very accurate day for what we're looking at for closing. We could put that on there. But know that that could change a little bit depending, unless of course we close 17 days out from the end of the month on this one. And if the down payment changes, that changes the loan amount. So that can affect that dollar amount a little bit as well. Sometimes lending companies will put the property tax prorations on this line here. Other times it's down here in adjustments and other credits. I'll just go over that now, since we do have that line item right here, even though there's no dollar amount. So you'll see property taxes here, and then you'll see property taxes here as well. So what this one would be, and what this one is on this loan estimate right here, is the property tax prorations. So most places in Michigan, not all, most places, the property taxes are paid upfront for the year. That means the people that you're buying the house from, they've already paid for the property taxes on your behalf. So it doesn't make sense for them to pay for the property taxes while you actually own the house. So it's just you paying them back for that period of time. And then it can work a little bit differently if the property taxes are paid in arrears. So then you wouldn't have a property tax proration. The next section here is section G, the initial escrow account or escrow payment at closing. So if you're not familiar with what an escrow account is, you can kind of look at it like a bank account that the lending company holds for you. So at the closing, you have to put a lump sum in there, and then every month as you make your mortgage payment, more and more goes into that escrow account. Then, when the next property tax bill becomes due, when the next homeowners insurance bill becomes due a year down the road, there's enough in that escrow account to pay those bills for you. So, if you have an escrow account, you'll typically get your property tax bills and homeowners insurance bills in the mail. The lending company will also get them. Whoever is servicing your loan will also get those bills, and they're going to pay them for you. The ones you get in the mail are just so that are there for your records and so that you can kind of monitor what's going on. So typically, they'll put about 3 months of homeowners insurance in there. Let's say you close in July, you skip August, September is your first payment. So right there, July and August, you're putting a couple months in there. And then property taxes, homeowners insurance, they tend to go up a little bit every year. There's always a little bit of a cushion in that escrow account just to cover the difference. Then there's two tax lines here. That's because in the great state of Michigan, we get to pay two property tax bills. This one right here is called the city property taxes. Just to make it nice and confusing, we also have multiple names for each one. So we also call that the summer property tax bill. And the only reason for that is because the city property taxes come out in July, typically, and the winter property taxes, otherwise known as the county property taxes, come out in December. So and they're yearly bills. So the city, or otherwise known as summer property taxes, are paid July all the way through the next June. And that winter property tax bill is paid December all the way through the next November. This one here, they're collecting 12 months of these property taxes and 8 months here, just to make sure that they've got enough in there to pay those bills as they become due. Note that at a $315,000 purchase price, these property taxes are extremely low, very, very low. You can't expect to find taxes like that. That means that the people who currently own the home, they've probably been living there for a really long time. And so what happens is the property taxes can only go up a little bit each year, a certain percentage each year. And they're not going to jump at any given time, except for when you purchase the house. So when you purchase the house, the tax assessor's office reevaluates the current value of the house. They do what they call uncap the taxes. They assign their millage rate. You can look up millage rates for wherever you live online. They apply that millage rate and assign the new tax value to that. So this client in particular, and know that if you're buying a house from somebody who's owned it for a long time, this will happen with you as well. So we're collecting a certain dollar amount here in the escrow account. It will not be sufficient once the tax assessor's office reevaluates the property taxes. This is just a little kink in the system that hasn't been fixed. Could use some fixing because we already know they're going to be short. And so what I always try to do is explain to my clients, like, this is the current property taxes. They will go up. Your escrow account will be short. And then once that bill comes out, the escrow department or the servicing department is going to reach out to you, and they're going to work with you on how to handle it. So you can pay a lump sum to make up the difference and keep your monthly payment the same. You can typically spread it out over 12 months or a 24-month period, just to ease the burden a little bit. And so a lot of times, they'll work with you on that. On the other hand, if the person you're buying the house from hasn't owned it very long, the property taxes aren't going to change a lot. And then once they make that initial change, then again, they're not going to uncap them again. So they're just going to go up a certain percentage each year, depending on where you live. Next one here, the other section, there can be a number of different fees that show up in here. Typically, it's a real estate broker fee or real estate transaction. They call it compliance fee. Sometimes that is the most real estate brokers, so not your real estate agent necessarily, but the real estate broker that they work for, charges a fee per transaction. It's typically somewhere between 500 and 695. I've definitely seen it for less than that. I've definitely seen it for more than that. So that's just kind of an industry average right there. So we got total closing costs of 10,539, down payment of 15,750. This client made a deposit of $2,000. And again, adjustments and other credits, for some reason on the loan estimate, they haven't put a line for the property tax prorations. And so it just gets shoved onto that adjustments and other credits. And then that's how we get to the 24,932. And then just know, once you get to that preliminary closing disclosure and the final closing disclosure, there's actually a page where it breaks down the number of months and shows you exactly the dollar amount for the property tax prorations there. But loan estimate, that's where it shows up. So that's everything I was going to go over on this. Again, if you have a loan estimate that looks completely different than this, or has some odd numbers, or whatever it is, please feel free to reach out to me. I'm happy to go over it with you. If you have any questions, drop them in the chat or comments, and happy to go over those with you as well. So yeah, wish you all the best in your home buying experience. Thanks.